When it comes to investing, a big obstacle many people face is the fear of catastrophe. Hi, and welcome back to another Money Not Math conversation. This is Money Not Math number 155, and we're going to be talking about how to avoid letting unforeseen events, known as black swans, ruin your retirement. It is Thursday, November 5th, and I appreciate you coming back for another Money Not Math conversation. For today's conversation, we'll be discussing How to Avoid Black Swans by David Booth, founder and chairman of Dimensional. I will include the link if you'd like to check it out yourself. Dimensional is one of the companies we use a lot for our portfolios, and I really enjoy their content, so I hope you enjoyed this conversation as well. Unfortunately, I wasn't able to do my weekly retirement planning coffee talk this morning, which is normally live. So hopefully those of you who were looking forward to that are able to find this Money Not Math video and enjoy this as well and get value from it. As always, if you have questions, comments, or concerns, please reach out or request for future topics. Please reach out directly or comment on this post wherever you're watching or listening to it. And more specifically and more appreciated, if you enjoy this content, please, please, please share it with a friend, either on social media or directly by sending it to them, because the more people I can provide value to, the better. And I really do appreciate that. So let's get back to the article written by David Booth. It starts out by saying, like I said, when it comes to investing, a big obstacle what many people face is the fear of catastrophe. If you invest in a stock, there's always the possibility that value may drop to zero. And that can be scary, right? In fact, we used to have a wall in the office lunchroom that was covered with stock certificates from liquidated companies. Most of those businesses likely had good ideas and solid plans. After all, they had reached a level of success that allowed them to go public, which, when you think about it, is crazy because most people don't even own a company, and most companies aren't even big enough to be publicly traded on the stock exchange. And then most companies that get big enough to be publicly traded on the stock exchange, many of them will end up going to zero, right? So they get big and then all of a sudden they crash, which is kind of a crazy thing to think about when you consider the risk and reward of starting, owning, and investing in businesses. But anyways, back to the article. And yet, eventually, each stock certificate was worth only the paper it was printed on. People have different ways of thinking about financial risk. Some refer to black swan events, the term, which was popularized by Nassim Nicholas Taleb's 2007 book, refers to unforeseen events that have a big impact on things like stocks or the market. In 2023, to take one recent example, the stock of Silicon Valley Bank went from $284 for one share to 90 cents in less than a month. So it dropped from $284 all the way down to 90 cents in less than 30 days. That's crazy. If someone held only that stock, they might have called what they experienced black swan. And that's a really important subpoint of overall investing, and we'll kind of get to this, is that it's so important to make sure you are not over, your portfolio is not overweighted into one company. Because there's been so many times that the companies will be doing phenomenal and we think, oh, we're not going to lose our money. Just ask Blockbuster, right? Ask Silicon Valley Bank. It doesn't mean it's impossible. Just because it's unlikely for a big, big company to just drop to zero or 90 cents in this case, it doesn't mean it's impossible. So continuing with the article, I have a different definition for black swans. And when I say I mean David. That's rooted in his 50 years of experience as an investor and his optimism for investing in public markets. In fact, he doesn't think he's seen a true black swan event during his lifetime. Back in the early 1970s, markets were down more than 40%, but they have never gone to near zero. So if you had $1 million in the 1970s, your million might have gone down to 600,000, and that wouldn't feel very good. But it has never gone to zero, and they've always come back up eventually. Of course, some people might think the stock market going down 20% would be catastrophic. Perhaps they are close to retirement and counting on every cent they've saved. That's why people often hold less in stocks relative to bonds as they approach and enter retirement. Remember, investors can control the amount of risk they take by adjusting the percentage of stocks in their portfolios. If half of your portfolio is in stocks and the other half is in less volatile bonds, a 20% decline in the stock market might reduce the overall value of your portfolio by only 10%. That's one way of protecting yourself against a potential black swan in the short term. Indeed, this strategy has helped cushion the blow of many market downturns, making it easier for investors to stay the course and avoid the temptation to sell at the worst possible time. So many important points referred to there. First of all, many people do decrease their equities or their stocks to bonds or fixed income as they near or enter retirement. And if the number one goal is to avoid volatility, that makes sense. However, what we have to understand and why this is so important that we don't just follow some rule of thumb is you have to understand what your personal goals and financial situation are. For example, if you intend to live a long time in retirement, we actually have to increase your income and increase your assets to maintain your lifestyle because inflation happens. If it's important to you to leave a legacy to your kids, we actually have to, at minimum, maintain, but likely increase your assets so you can not only enjoy your retirement, but also leave something for them. If the plan to retirement is to spend to zero, so there's no legacy, well, how do you know what day the zero needs to happen? How do you make sure that you don't run out of money before you run out of breath? Right? So it's okay. Of course, it's okay to shift some of your equities to bonds, but please don't do it all of it out of just fear of volatility. Because another thing we have to understand about volatility is when you're still saving your money, volatility can actually be a good thing. Because when the market's down, we get to buy more shares for the same amount of money. When the market's up, we buy less shares because it costs more. And over time, that's called dollar cost averaging, which helps enhance your returns. The other thing about owning stocks versus owning bonds is owning a stock is like owning a part of the company. And when you own part of a company, many companies will pay you a dividend for that ownership. You get part of their revenue. When you own fixed income or bonds, you're loaning your money to another company to use it. And historically speaking, the stock market's gone about 10%. Bonds have only accrued about 5%. So over a long period of time, owning companies is twice as good as loaning to companies. And that compounding is significant over an extended period of time. So another important point there, he talks about if half of your portfolio is in bonds and the market goes down 20%, maybe you only lose 10%. Well, that could be true if the bonds aren't down too. In the last 10, 15 years, unfortunately, bonds and fixed income are oftentimes down when stocks are down. So it's not like they're countering the negative, they're just decreasing the negative a little bit. But again, it all depends on how you're investing and what your goals are. So that's the biggest thing I want you to take from this, in my opinion, is everything he said is true. And there is no simple rule of thumb that should be followed for everyone because it's completely dependent on your personal situation, your personal goals, and your personal, I guess, ability to look at the long-term impact of inflation versus the short-term impact of volatility. Also, how are you planning around market downturns? So, coming back to the article, the fact that winners can gain more than losers can is one of the many reasons he's so optimistic about investing in public markets. Staying disciplined is one of the keys to capturing the market's long-term returns. Over the past century, the stock market has returned on average about 10% a year, which makes sense when you consider the asymmetric nature of stock returns. Remember that while a stock can only fall to zero, losing 100% of its value, successful companies have the potential for gains far exceeding 100%. Take Nvidia, for example, whose stock price has increased by many multiples in recent years. This asymmetry, the fact that winners can gain more than losers can lose, is one of the many reasons David is so optimistic about public markets. And to give you a reference, I'll look up Nvidia's returns the past 5 years. Again, I do not encourage you to only invest in one company or even just a few companies. I'm a big believer in diversifying, but just to give you a reference, the total return for Nvidia stock is 187% over the past 12 months. So a stock can only go down 100%, but Nvidia went up over 187% in the last 12 months. The last 5 years, this one company, Nvidia, is up 2,462%. I'm rounding. Meaning $100 invested in Nvidia stock 5 years ago would be worth $2,561.61 today. All right. So again, the optimism of investing in the market is it grows, it can compound growth significantly more than it can compound lose as long as you spread out the risk, which we'll get into more here. So back to the article, because the protection against catastrophe that a diverse portfolio provides is quite different from other forms of risk we experience in life. When you buy the market of stocks, you are buying a little bit of thousands of companies, assuming you are diversifying into thousands of companies. If you only buy two companies, then you're only diversifying across two companies. So if you're diversifying your investments across the market of stocks, and so you own a little bit of thousands of companies, it would be like spreading the risk of buying a house among thousands of homes all over the world. Imagine if instead of one job, you had a little bit of thousands of jobs in every sector of the economy. You'd never worry about losing your job, would you? Holding a market portfolio isn't just about reducing your risk from black swans, however you define them. When you start to feel that you have an investment plan that protects you against catastrophe, you can start to feel better. That's why it's important to have a process you trust, which means process you understand. Of course, there are no guarantees when it comes to investing, but you can put yourself in a better position to pursue your goals and win in investing and in life. So again, thank you so much for taking the time. Please follow up and take a little bit more time by letting me know what you think and or a request for a future topic by commenting or reaching out directly. And the best thing you can do or the biggest comment you can give me is if you're willing to share this with a friend directly or even better yet, or potentially better yet, on your social media page so that I can hopefully provide more value to more people. Thanks again for your time. And last but not least, the most important part, this is a disclaimer. This content is not legal, tax, or investment advice. You should always consult a qualified professional regarding your personal situation. So even though I am legally licensed to give financial advice, we haven't signed a contract more than if you're just watching the video. So I'm not giving you specific advice from a legal standpoint. All right. So thank you again for your time and have a wonderful day. Bye.